Equities were higher. It looks like they are flat to pulling back just a little bit, but gold is down 1%, so not the kind of moves we've seen before. We're going to talk about that and a little bit about private credit today with Professor Mark Guthner on Office Hours. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner of Rutgers. Mark, how are you, my friend?
I'm doing well. It's starting to get cold here, but it's not awful, but it's moving in the wrong direction as far as I'm concerned.
Well, over here, it's not that it gets cold, it gets colder. It's probably, I don't know, maybe 10, 15 degrees colder on average during the winter than it is during this summer, so it's not a huge swing. But what makes it feel much colder is that it, one, gets wetter in the winter in California, as you know, and the other is that because the days are short.
Yeah.
And, if it's 60 degrees outside but sunny, it feels warm. If it's 60 degrees and humid and dark, it feels very cold.
Yeah, damn.
So even absent the temperature difference, you definitely get an impact. So the first thing I'll say to everybody is, because I'm going to be going on CNBC from the San Francisco Bureau this afternoon, we are going to have to keep this one pretty tight, so we intend to do that. One of the things that we talked about yesterday that I think is kind of interesting, and Mark, I'd love to hear your thoughts on this, is that we had this sort of prolonged period where everything was rising together, particularly gold and equities going up together, and that relationship appears to have broken. My own take is I think that's kind of a good thing because I was getting a little concerned about that runaway debasement trade. What are your thoughts on that?
Yeah, well, I think you're right. I was getting concerned about sort of the excess frothiness in gold, in that it was going up a lot every day. And the story is very good. Money supply is growing. It looked like quantitative tightening is going to stop. So the Fed, even though they were starting to lower rates, or rates were starting to drift down in the marketplace, the Fed was still letting assets run off their balance sheet. They're kind of hinting, they're wiggling a shoulder or something that they're going to stop quantitative tightening. Or letting assets fall or roll off their balance sheet. So maybe in response, I would have liked to see them continue to do that, but it's kind of interesting that as they were trying to shrink money supply or the base money, gold was ignoring that and focusing, I think, on M2, which was growing fast. So net, what's happening there? Net, there's a little bit more leverage in the financial system if they're shrinking base money while the size of loans outstanding is growing. So I'm happy to see the price of gold come off a little bit, although I think it's a correction. I think there's going to be another blast to the upside in gold, and I think we're going to get that because the Fed is poised to cut rates this week, and it looks like from Fed Funds futures that they'll be cutting into next year, and so they're giving up. To my mind, they're giving up on fighting inflation. Not a good sign.
Yeah, they did not get down. You have said this many times that the 2% target is a target floor, not a target ceiling.
Yeah,
that's
right.
It looks that way because we haven't gotten to 2% even now. So we're not underneath it, we're still above it, and yet they would start relaxing on the monetary policy side. I mean, my thinking on the balance sheet is that if there was not going to be a rate cut as well, I would sort of think about that as anticipating, because you mentioned that, of course, the banking system, creates money as well. And there are some cracks in the credit markets. I don't know how big they are because I don't know how big the market for private credit is, and whether some of the recent things that we've seen, where we've had some of these subprime auto loan outfits, start to have some problems. But you are a credit guy, and as it happens, you are married to somebody who is in the car business on the retail side, so knows this pretty well. I mean, we've discussed it over the years. What's your take on this? I mean, how big a problem is this? I mean, on the private credit side, I will just say the one thing, it feels to me a little bit like late 2007 in that business. But that business is not as big as the home mortgage business. So is this something we need to be worried about?
Maybe not yet, but maybe in a few months, yeah. Or maybe what's going on with Tricolor. They just went under. It's my understanding that auto lenders outstanding is about a $1.7 trillion. I mean, that's a pretty big number. What I don't know in that number is how much of it is subprime versus prime loan, because companies like Tricolor were lending to people that had really bad credit. So, they were paying 12, 13, 14% interest on a car and buying expensive cars. There are two things kind of hammering people right now. One is the price of cars have gone up a lot in the last, let's say, 10 years. The average car sold in the U.S. is about 50 grand. It's kind of funny. The house that I grew up in, now bear in mind I'm 67 years old, cost my parents $27,000. So when I was
the house that my parents live in now, I believe they bought that house for $24,000.
Yeah. So
now they've done significant improvements. I mean, just to put things in perspective, this was a rundown shack of a New Hampshire farmhouse when they bought it. So it was in very rough shape, and they've done a lot to make it livable. Yep. But I mean, it's unfathomable now.
The inflation, and it's unfortunately we all accept inflation as a given, that we don't demand that the federal government balance its budget, and that the Federal Reserve not print money. That if the federal government's going to run $1 or $2 trillion budget deficits, the private markets can't suck it all up, and while keeping interest rates at a reasonable level for everybody. So to manage that, the Fed buys a big chunk of it. And that's why we get lots of inflation. One should not have been surprised, although it seems the Keynesian economists were very surprised, that we had a big blast of inflation when they said, no, you can't make anything. And two, here's a pile of cash, go spend it. Every Keynesian economist, mainstream economist said, this is a one-time thing. It's not systemic. They had all kinds of nonsense on why we weren't going to see big higher prices. The only guy that was mainstream economist that I saw saying you're all wrong was Mickey Levy. He had written some papers. Mickey's a very interesting guy. I knew him from CRT. I knew that was Chicago Research and Trading, not the same CRT we worked at. Which was an option shop, and then he was the head of economics for the business bank at Bank of America, and he had written a paper during this time and was roundly hammered for making the case that we were going to see much higher inflation when the government was running whatever huge deficits, multi-trillion-dollar deficits, and the Fed was printing all the money that the federal government wanted. So these things go hand in hand. If we want to get rid of inflation, we've got to have a balanced budget. And the Fed's got to not print money for the private sector, just let everything balance. And we can see a world where we'd have a nice, robust economy and low interest rates. Once we we got over the hump and we make the
Low real
transition.
interest rates.
Yeah. So
Yeah. I guess that's one of the things that I think is really important is that, obviously a very high interest rate environment is destructive. It creates all kinds of decision making within the economy that isn't necessarily beneficial in the long run. People feel compelled to spend money. They think it's going to be debased over time. The most extreme examples are economies that have seen hyperinflation and people get paid in the morning and they race to spend it before the afternoon. We don't think about it that way because we haven't experienced real hyperinflation, but we have experienced high inflation. And one of the things we've observed in high inflation is that not so fast that you run to the grocery store to get your bread before your money is worthless, but people are inclined to spend and not save. So savings rates have declined precipitously, especially in the lower, the lower income demographic. I saw a statistic that was saying that the subprime auto delinquency rate was approaching 7%. Delinquency being defined as more than 60 days in arrears.
yeah,
You said that you think that the size of this market is how big? 1.7 trillion. Is that
yeah,
the number you just threw out?
like,
That's pretty big,
it
actually.
is.
That's like this. That's like That's about the same size as student loans. So when that starts breaking, that is a problem.
Yeah,
Unlike, so is that what you think this is what the Fed might be doing? Because when we had the mortgage crisis, the heterodox policy response to that was, well, essentially you're going to suck that much out of the money supply as that credit essentially implodes.
yeah,
And so their logic was, well, we can essentially stabilize the money supply by buying a lot of these assets in many cases, and they started buying non-government assets. So now they're buying all kinds of stuff. Do you think this is is it possible you think that this is in anticipation of that they see an emerging problem on the credit side and their decision to stop the tapering? And by the way, just so everybody knows what Mark's referring to, I'm sure most of you do, but obviously, the Fed's balance sheet has grown over time. It used to grow fairly steadily. In fact, it grew at approximately the rate of the economy, we could say, before the GFC. Then all of a sudden, it exploded. I mean,
yeah,
trillions of dollars. Now, the thing is that if the Fed simply stops buying treasuries, the size of its balance sheet will naturally decline over time, and that's because the debt that they purchased is steadily maturing over time. So as that debt, in theory, if they didn't buy another anything for 30 years, eventually the Fed's balance sheet would be zero,
yeah,
because probably that's the longest dated paper they've got. And it would probably decline significantly well before then to anything meaningful because, I'm sure that the average maturity for the Fed's balance sheet, I haven't looked at it, perhaps you have. Do you know what the average maturity on the Fed's balance sheet is?
I do not know, but I suspect it's something like 7 years, but I don't know for sure. They own a lot of stuff across the curve, and the government does issue tons of money on the short end, so I'm sure they own a lot of that too. So
Especially lately. They did under Yellen. So that was one of the big criticisms of Yellen's policy, was that she was issuing tremendous amounts of debt, more than usual, in very short dated paper. And that was very much a borrowing from tomorrow to spend today kind of a policy
yeah,
because the amount of, effectively she could have financed considerable amounts at, call it 1.5% out 10 plus years. And instead elected to finance that at 60 basis points, let's say, at the short end. But the problem, of course, is that when rates increase, that's trillions of dollars that have to be refinanced at now interest rates which are 300 plus basis points higher than they were.
yeah,
You could sort of see where that leads. That's a complete disaster. That's $30 billion per trillion. at least, and there was $9 trillion that had to be refinanced just this year alone that was part of that short-term issuance, right?
Yeah. And recall that the low in the 10-year bond was about 50 basis points. They should have been issuing everything 10, 20, 30 years. Every issuance should have been that. But, they get greedy because during that time period, they could borrow for free. The interest
And
rates
there
were a
was
couple of
just a
basis points, and we're all paying for it now, you know.
I think, well, we are all paying for it. I think one of the problems too, and actually I'm going to pull up a chart because I think this kind of tells the tale. It's worth,
interest expense
yeah,
is close to $1 trillion, or is over $1 trillion a year now. That's just ridiculous.
yeah, well, actually the chart I was going to show is a long-term 10-year treasury rate. We have to remember that one of the reasons that, first of all, you had a lot of economists who had come up with pretty cockamamie ideas about the idea that inflation was not a monetary phenomenon. Yeah. And they had sort of somehow convinced themselves of this. I think they did that because it's a convenient belief. Believing that permits you to do all kinds of things, which they did, it should be said. But I actually think that in another way, I can understand how folks sort of subscribe to this idea a little bit. And this is the reason right here. And that is that we went through this tremendous period of a bull market for bonds, where rates just steadily declined year after year within a channel, but the trend was generally lower.
Yeah.
And I think that they were all largely living on the dividend that Paul Volcker created. First of all, he crushed the inflation bubble of the late 70s and early 1980. And I think two things happened. One, that lowered inflation expectations in general. And two, I think it helped people believe that the Fed would be that kind of a responsive entity. That the next time that happened, that they wouldn't let it get that far out of control and would be much quicker to respond. And so that gave people additional confidence. And then, of course, we had the late 1990s and into 2000, 2001-ish, before the GWOT, the Global War on Terror, where we actually had, some benefits from the Clinton era, where we had... we were running, obviously not with respect to the unfunded liabilities, but we had a balanced budget, at least on a cash accounting basis.
Yeah.
So that didn't account for a lot of things, but that's remarkable because that was really, I think, the first time that we had that for, in the post World War II era, right? It was that brief window of Clinton in the White House and Gingrich in the House.
Yeah.
And you combine that, with what had preceded 2 decades earlier, and you had this Goldilocks situation.
Yeah, well, this is another. There's a lot to unpack there. Yes, Volcker crushed inflation. He put the economy through quite a heavy turmoil by ratcheting up interest rates and putting a clamp on the money supply. But we all forget that we had 2 huge tailwinds then come in at the same time with him. One is the wall fell, and the Soviet Union is chock full of natural resources. So he had a huge boon in natural resources. So anybody who wanted
that was not, but that did not happen until about 10 years after his really restrictive policy. The Soviet Union fell. It started to collapse in the late 80s and into the early 1990s. I don't remember exactly which year it fell, but it would have probably been around, if my memory serves me correctly, 90, 91-ish.
Yeah. Well, what I'm saying is that drop in inflation may have been short-lived. It may have worked for about 10 years. And then now we've got high natural resource expenses to now work into the economy. If you go look at the price of oil, for example, it hasn't changed in what is it, 30, 40 years? I think we showed a chart, and then last week. So that means net it was going down after inflation. And then we also had the massive offshoring. So remember, China joins the World Trade Organization. There's 1 billion people now available, very low labor rates for manufacturing. And so then there was the mass offshoring of manufacturing from the US to China. And that was a big help as well, in terms of, if you want to measure, say, inflation is call it price inflation. What did prices do? Those are two things that help keep prices down as well. So there was, to my mind anyway, there was more than just that. And if we go back and we look at oil, go look at oil to 1980. And we're at 63 bucks actually, here.
Yeah, hang on a second. Let me.
He's stuck. 82. That's good.
What was that?
You were close there. There's
yeah,
82. Yeah. Well, we go back. The price of oil is unchanged back to 2004. It's a little bit.
Let's see. I'm gonna
draw a line there.
I'll draw a line. We are at 60 bucks basically. So.
Which is where we were in 2004.
Right here. So this is I mean it's 20 years. It's unched in 20 years, but in real terms it's lower, of course. Yeah. It's much lower.
And I would guess we went back to 83 net oil prices were mildly negative on a real return basis. Cuz the price doubled. But inflation averaged about 3.5% during then. So let's just do a quick piece of math. I'm going to go 65. I'm going to divide that by 30.
Yes. 40 years. 40 years it's unched.
And then...
40 years it doubled, excuse me. So probably that is unched, I'm sure.
So the average increase was about 2% a year, compounded. And interest rates, or inflation was about 3.5%. So net, our energy costs get down. What's really, I think, remarkable is our consumption of energy per unit of GDP fell during that time period as well.
We're manufacturing less.
Yep.
We're more service-based. Obviously a huge tailwind for, energy consumers was fracking. The Permian the United States becoming the world's largest energy producer by a pretty substantial margin. Outperforming Saudi Arabia. This is something that if you had said that in, the late 80s, that the United States would be the biggest, fossil fuel energy producer in the world, outpacing Saudi Arabia by a pretty substantial margin, I think most people would just say you're nuts.
Yeah.
We use the oil in Texas. We use the oil in Ohio. California's not going to let you use the oil that's underneath the state. And actually, to a certain extent, I suppose that remains true. But advancements in technology absolutely change things.
Yeah.
People can argue about whether or not, and there's plenty out there to suggest that there are things about fracking that one doesn't like. But in general, we have to say that for consumers and for the wealth of the world and productivity and everything else, it was a huge benefit.
Yeah.
So let's get back to this this credit issue though, because like I said, when people look at this, what I'm really curious about is at what point do we begin to worry that this is going to impact equity prices? Because I think that's when we think about things, that's usually what we look at. Because, to me, the cycle sort of works this way. We have a credit event. The credit event percolates through. Equities roll over. Consumer confidence declines. And suddenly we find ourselves in, and then that turns into a real economic slowdown, right? You suck out the wealth effect. there's like a bunch of compounding things that can take place. What are your thoughts here? What is it going to take to either convince us that it's not something to worry about or that it is?
I guess if there is some follow on, what I think is problematic is these are private loans, and these companies that are involved, like Tricolor, they're financed. These are private equity businesses. They're financed with private finance. To the extent that it's not, the losses are being suffered by somebody that's not a bank, that's probably a good thing because they're not going to get bailed out, whoever those people are. There's a lot of private funds out there that are lending money to private equity. They have this symbiotic relationship, as they can get higher interest.
Who are the big buyers of this? Is this like ultra high net? Is it institutions like pensions and trusts? I mean, if it's the latter, it worries me more than if it's
I'm going to guess it's
net.
both, because there's been such a move to get into private equity. So, there could be a blow up coming in private equity, because these guys they lever their firms to the max, and so if everything doesn't go exactly right, they often default and have to go into some kind of restructuring. I just did a quick lookup with Grok, and it says that the leveraged loan market is $1.5 trillion. So leveraged loans is debt that's lent to somebody who uses the money to make an acquisition. And then they use lots of leverage, the LBO kind of thing, 80% debt, 90% debt, something like that, 10 or 20% equity.
It feels a little like also, the heyday of the Drexel Burnham days as well, and the LBOs. It kind of makes me think that Berkshire is not a bad, Berkshire got downgraded, and I disagree with this.
I do too.
Because they've got $500 billion of cash essentially on the balance sheet. And, people are saying, oh, well, Charlie's gone and Warren's leaving. But these are operators, and I think they have all worked together for some time.
Mm-hmm.
And my thinking is they're sitting there just waiting. They can afford to be patient. And, let's take a look at their valuation, actually, because...
Yep.
This is one of the things I was pointing out. I was looking at Zoom. So Zoom is about 30% cash right now.
Oh.
And yeah, it's pretty remarkable. So here we have this situation. If we're looking on an enterprise value basis, so we strip the cash out, we call it $500 billion to keep the math easy, and we say, okay, they're going to do $45.8 trillion in net income next year. Now, my point that I was making before is that you have to take away $20 billion of that straight away, because that $20 billion is essentially interest income.
Yep.
On the $500 billion of cash that they're holding. So where does that leave us? We'll just call it a $500 billion, $500 billion business valuation, and operating income. We can squabble about what that number is, but let's just call it half of net income. Let's just give them the benefit of the doubt on their rate bets and suggest that half of their anticipated adjusted net income from next year is interest income and the rest is operating. So that gets us to about $22.5 billion. And on that basis, it's trading at 22 times forward earnings. And with the S&P trading 26 or 7, NASDAQ trading in the low 30s, and just being queued up, you buy this because of their operating businesses, but you buy it also because you expect them to be able to deploy their capital opportunistically.
Yep.
And I think they will. I mean, I don't get the downgrade. You could say, all right, well, the insurers, they have a lot of stuff on their balance sheet, and those assets could decline a bit, in a pullback. I'm with you. I'm with you on that. But how does the insurance accounting work in that case? I mean, do they also get some sort of, similar benefits that the banks do with respect to assets that underpin, their balance sheets essentially against anticipated liabilities?
I'm not sure I understand your question, but they have to hold.
Well,
they have
what
to
I'm
hold
saying is, like
assets
in a
behind-
bank's case, you have your held to maturity book,
Yeah.
right? And it's just amortized through time, and they don't market to market. Insurance companies have all of these assets that underpin
I see
some
what you're saying.
forward liabilities. We don't know what those liabilities are. Sometimes they're higher, sometimes they're lower. But the only issue that I would think some people might point to is say, well, they have, they're not just basically sitting there only with cash, because they have such a huge percentage of their business from insurance, and that insurance is, backed up by considerable assets like publicly traded securities, for example, that you're saying, okay, they have some measure of exposure. I'll go along with that. But I still think that relative, you can't say that they have more market exposure than NVIDIA or Amazon or Microsoft.
Well, that's for sure.
They have some.
Yeah. I haven't looked at insurance company accounting in a long time. But it used to be pretty similar to pension fund accounting. So they had, back when I used to manage pension fund money, there was FASB 86 and FASB 87. Up until that time, in 86 and 87, those are just the years in which they came out. But up until 86, pension assets and liabilities never showed up on a company's income statement and balance sheet. They were just on the footnotes. We have to pay out this amount of pension, stuff like that. So when 86 said you've got to put it on your balance sheet, and then there was some smoothing that went on. There was like a transition period, transition rules. Then 87 came along, and the companies said, you can't just make us mark to market the assets every year, because here we've got, let's say we've got $3 billion in pension assets and the stock market goes down 40%. You're going to tell us we got to wipe out, $200 billion worth of, or $1 million, something like that, some really big, large number, and have it hit our income statement. So you're going to make our income statement super volatile, and people aren't going to be able to understand what's being caused by the pension plan and what's being caused by the actual operating business. So they compromised, and essentially you would write down losses over 5 years. So if the company lost, $1 billion in its pension plan, they wouldn't have to write off $1 billion in a year. They'd write off 200 million, and it would go down 200 million the next year, and so on. But if the market recovered, of course, that volatility would go away. So insurance companies do the same thing. There's a lot of smoothing out of asset returns on insurance companies. So
I think, my thinking right now for people who are long equities is you can barbell it by owning a little bit of Berkshire and just know that what you have is a pool of assets that's ready to be deployed opportunistically, knowing, by the way, that Berkshire's phone is likely to ring. Unfortunately, that's all the time we have today, much shorter than usual. And the reason is because I got to get into San Francisco, and hopefully I don't hit any traffic, for a little bit of CNBC halftime report with Brian Sullivan. So anybody who's interested, I'll be on the air for CNBC at about 1:30 Eastern in less than an hour. So I better get on the road, Mark. I'll let you get back to your students. Yeah. I'll let you get back to your students. All of those of you who tuned in for this abbreviated version today, I appreciate your time and attention. And be sure to tune in next week when hopefully we can do it for the full hour as usual. Yeah. Thanks for watching.